Hey guys, welcome back. This is the first part of REG. So, Chapter 1, we're going to be covering regulations governing practice before the Internal Revenue Service. So, pretty much, if you're going to be a tax accountant, and that's why we're studying for REG, first thing we need to know is everything you need to know about practicing before the IRS. So, we're just going to dive right in, we're going to keep it short, and then give you all the information that you need to know for the examination and try to cut out all that other stuff that you don't really need to know. So, here are the learning outcomes for today's lesson. So, first, recall the regulations governing practice before the Internal Revenue Service, and secondly, apply the regulations governing practice before the Internal Revenue Service given a specific scenario. So, the first thing you need to know is Circular 230. The IRS has rules on who can practice before the IRS. This basically means anyone who files documentation to the IRS or talks to the IRS must abide by these rules. Going further, who may practice before the IRS? You have attorneys, you have CPAs, enrolled agents, enrolled actuaries, and enrolled retirement plan agents. Really, you don't have to memorize all these, but you should just have a general concept of attorneys, CPAs, enrolled agents, blah, 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 blah. So the usual group of people that are going to be practicing before the IRS. You're not going to see too many questions about this, so just know the general concepts. So we're going to walk through in the most simplest way the requirements, the due diligence, and everything you need to know about practicing before the IRS in the most simplest terms possible, because the jargon with a lot of these terms get so dense that you can't even follow most of it. So we're going to run through all of them as quickly as possible. So first one, comply with IRS request. If the IRS asks you for information, you probably should send that information in. You can't say that there's privileged information and you're not going to send it. No, for the most part, if the IRS wants something, they're probably going to get it for the most part. Secondly, you don't have to tell the IRS everything. Right? You don't have an obligation. If your client made a mistake, you're going to tell the client, hey, you made a mistake. You probably should fix it, because if you get audited, then there's a chance that you're going to get found out. You're going to have penalties, interest, and fines associated with this mistake. Right? And it's up to the client for them to fix that mistake. Now, if they don't, then you have to actually question the relationship and whether or not you want to work with this person in the future. But the last thing you have to do is tell the IRS that your client made a mistake. Next one, due diligence. So you cross your I's, you dot your T's, you make sure you're doing the best job you can possibly do. Next one, be timely. Make sure that you file the returns on time. The next one, avoid troublemakers, right? You don't want to be working with people who have been disbarred from practicing with the IRS. Pretty simple. Former IRS agents. If an IRS agent quit, they shouldn't work for someone they audited. So if you have someone who's an IRS agent, they're auditing the books of Microsoft, it looks a little weird if the next year they're working in internal audit for Microsoft. Right. Notaries. You can't notarize your own documentation to the IRS. Pretty straightforward. Rules on fees. You can't charge unconscionable fees, right? If someone comes in, they want to do a 1040, you can't say that's going to cost you $100,000 and your annual income is $10,000, right? It doesn't make any sense. Next one is you can't charge contingent fees. Now, contingent fees, basically, whatever your refund is, I'm going to charge you 10% of that. So if I give you $10,000 back, I'm going to charge you 10% of that. I'm going to get a $1,000 fee. That's a no-no. Return your client's records. If your client asks for the information back, you should send it back. Even if they're not paying their bills, you still have to send at a minimum the documentation that is required to file their tax return. You can't say, I have all your tax information, you have to pay, or I'm not going to send it back. That's a no-no. Next, conflict of interest. You can't represent a client if it means it would adversely impact another client. So this is a big case in divorces. So if you have two clients, right, and they're both deciding that they're going to go through a divorce, it's hard to, do your due diligence and make sure that you provide the best service to one client and also the other client. Because for the most part, in a divorce, not all sides are going to be equal. So it's hard to navigate those complexities with clients that are getting divorced. So there are ways around this. You reasonably believe you can be neutral, the representation is not prohibited by law, and each party signs a waiver, and you keep it for at least 36 months, right? Next, advertising and soliciting. This is a no-brainer. No false advertisements. You can't say, guaranteed everyone's getting a refund of at least $1,000 or more. Probably not. Negotiating checks. You shouldn't deposit clients' refunds into your bank account. That's pretty self-evident. Some best practices: communicate with your client, establish the facts for any tax positions you take with the clients, advise your clients on tax positions you're taking. You should act fairly, put procedures in place to comply with these best practices. Next one, signing tax returns. Don't advise clients to do illegal things. It's pretty easy, right? Tell your clients the ramifications of those tax positions. Let's say, for example, they really want to write off those deductions, but there's a good chance that it might be disallowed. You basically just tell them, hey, this is deductible up to this amount. You want to deduct this, but hey, chances are you might get audited. They might be disallowed. These are your odds. You can rely on good faith information your client gives you. So, for example, if your client says that they paid $10,000 in real estate taxes, they paid $10,000 last year, you don't need the actual documentation that says they paid it. You can take their good faith word on it. Next one is competent. You probably should be competent. Sanctions. The IRS will punish practitioners who do bad things. These penalties can be as high as 150% of the gross income derived from the stated services. So, for example, if you charge a client $1,000 to do their tax return and you were completely fraudulent, right? The IRS could charge you $1,500 in penalties and disbar you from practicing. So that's pretty heavy stuff. Right, so we covered a lot of information here. So let's just put a nice conclusion on it. This is basic facts. It's pretty straightforward. You don't have to memorize all these facts, but just know you use common sense. A lot of these questions are super easy, right? So, for example, you have a CPA. They offer their client that they're going to deposit their money into the CPA's bank account. That's probably a no-no. Or the CPA says to the client, hey, the chances of the IRS auditing this is pretty slim. It is illegal. However, I think you can get away with it. That's a no-no. Or false advertising. You can't put false advertising out there. It's pretty straightforward. So, the article is on the Daily CPA website. You can check it out. You can run through it. This section is not going to be tested too heavily. It's about 10 to 20% of the exam, especially this part. You're going to have 1 or 2 questions, not anything crazy. So don't memorize too hard, but just know the facts. Use common sense.